corporate taxation, which is being held, we hope that it's the first of a number of seminars to be held across Europe by Green European Foundation. I'll say a bit more about them in a second, but first of all, I do want to thank the European Parliament Office in Ireland, and particularly MEP Gay Mitchell, for hosting this event here this morning. Green European Foundation is a European-wide foundation of the Green Movement, affiliated to the Green Group in the European Parliament, to which we ourselves in Green Foundation Ireland are likewise affiliated. Otherwise, we're completely independent, and we are grateful to the support of the European Parliament, both in hosting this and in funding the seminar. We have an interesting morning ahead of us. This is a crucial debate across Europe, and I hope that we will begin ourselves to find a way to point a direction without throwing big brickbats at each other, which is, I suppose, the level at which the debate currently stands. And I think what Green European Foundation wishes to do is to move that debate to find a workable and fair solution for all. And we have a distinguished panel here with us this morning who will address that question in a serious way, I think. But to introduce them, I would myself like to thank and introduce distinguished broadcaster and historian John Bowman, to whose dulcet tones I awake gradually every Sunday morning, and we're very grateful to you for that too, John. Thank you very much. Please go ahead.
Thank you, Nuala, and thank you very much for asking me to chair this session this morning. It is very much an interactive session, which we will have space at the end of the opening three papers and the second session again for questions from the floor and contributions. Some people are very clever at hiding a contribution within a question, but equally they're entitled to sort of make a contribution, because that's part of it as well. But do tell us your name and organisation, if any, so that we can capture the spin, if any. So let me first of all introduce Sheila Killian, who's very widely published in this particular field, and she'll be talking about the big picture of the this issue, creating a fair system on taxation, what can be done. Would you welcome Dr. Sheila Killian of the University of Limerick.
Thank you very much, John. So, in order to make the presentations a little complementary, I'm looking at the bigger picture, and I know Jim is following up with more specific cases in Ireland. So, in terms of the bigger picture, what is a fair corporate tax system? What's fairness in terms of corporate taxes? We tend to think of fairness and I'm going to zip through this a little bit, but we can discuss it afterwards. We think of fairness in terms of a bigger slice of the pie. Are we paying too much tax? Are companies paying too little tax? And in general, it's true that the tax rate that has been applied to companies is falling in OECD countries. There is what's known as the race to the bottom. You can see over time there's the average tax rate, the headline rate of OECD countries, plunging down towards the x-axis, which the more observant of you will see is set at 25%, which would be an appallingly high tax rate by Irish standards, but this is almost a floor as far as OECD countries are concerned. Apart from the falling headline rates, you also have falling revenue as a percentage of GDP. That it has generally fallen over time. In Ireland, the picture looks a little like this, as corporate tax take as a percentage of GDP. Again, this isn't a great measure in Ireland's case, because our GDP is strange, with the interest of diplomacy. It's somewhat inflated by other things. Apart from tax take as a percentage of GDP, you could look at tax take as a percentage of total revenue. Where is Ireland getting the tax? They're getting a very small amount of it from companies. A lot of it comes from income tax, which we pay. It comes from excise duties, which we pay. It comes from value-added tax, which we pay, because companies are registered for VAT and it's a flow-through. So most of the tax revenue that's gathered by Ireland comes from the people of Ireland. When you consider the scale of the national debt, and you divide that by the number of people in Ireland, that gives you an idea as to why people think within Ireland that perhaps corporate tax is unfair. The reasons that other people think there is unfairness in the tax, the thing that motivates the OECD, and I'll come back to this a little bit briefly later, is that the ability of large companies to reduce their taxes, and again Jim will talk more about specifics, comes largely because they have presences in many countries, and they can, because of the prices at which they sell to each other, by setting transfer prices aggressively, they can shift income from high tax to low tax, and in the case of a double Irish onto no tax jurisdictions, and thereby reduce their overall tax burden. Even that language is kind of interesting. That's coming from my background as I trained as a tax consultant, that we are trained, socialised to think of tax as a burden as opposed to a contribution to the society in which we live. But it reduces their overall contribution. This is only available to multinational companies, not available to domestically centred companies. This disturbs the OECD for reasons that we'll come back to a little bit later. A more pressing person who is disadvantaged by the corporate tax system, or a more pressing constituency, is the Global South. Because southern countries, in general, kind of need to gather a bit of corporate taxes. The reason they do is they have a big informal economy, they have a lot of people, individuals who are very poor and outside of the tax net, so gathering income tax is a challenge. Gathering VAT and sales taxes is an even bigger challenge, and some of the large bodies like the IMF and World Bank are encouraging them strongly to get rid of tariffs and border taxes. So they're left with trying to gather taxes from companies. As long as in the north the tax rate is plummeting down and there is a system of shifting profit north to low tax jurisdictions, that becomes very difficult for them. That's not an academic argument. You know, in countries like Zambia, where you've 1 in 4 kids who are stunted due to malnutrition, it becomes fairly serious to look at the Ireland-Zambia tax treaty. That's not just something academic, that's children's lives you're talking about. So there's unfairness in the system. The question is, are we talking about a few bad apples, pun intended, or are we actually talking about something systematic? Coming from my background as a tax consultant, I would say we're certainly talking about something systematic, because mostly how you learn about tax, if you join an accounting firm and train as a tax consultant, is you learn that tax is a big, horrible, nasty thing like a tsunami, and your duty, your professional duty, is to protect your clients from this nasty thing. So the system is geared around that companies see it as a natural and ethical thing to reduce their taxes as much as possible. When you talk about a few bad apples, you can talk in terms of companies, or you can talk in terms of countries. So you can think about countries that behave aggressively in their tax policy as well as companies. And again, this might be something that Jim will be touching on later. But the competition is not just countries, it's companies, it's also countries. And all of this contributes to the idea of fairness or unfairness in corporate taxes. So if the current system isn't very fair, are there any kind of big alternatives? And there are some big alternatives that are being considered. On the right, you have certain North American think tanks and also Oxford, who think, well, gee, these companies are hard to tax, let's not bother. Let's just let the profits flow through. When they're paid out to the shareholders, they can be taxed. So, you know, don't bother. There are many things wrong with that. I could be here all day. Countries operate in a particular economy, they should pay taxes to that economy. On the other end of the scale, you have the Tax Justice Network, who think there should be a unitary tax. And a unitary tax means, okay, you've got a multinational, they're shifting their profit around between countries, let's forget all that messing, and let's just tax them on their worldwide income. And then we'll worry about how you apportion that tax among all the different countries that they operate in. This is something that is being resisted somewhat by the OECD. Some bodies feel corporate taxes are hard to collect. Sales taxes like VAT are easy to collect. They are easy to collect in developed economies. They're kind of invisible. We don't notice it when we're buying things. We don't notice we're paying tax all the time. Also, homeless people, students, poor people, everybody, we collect sales tax from them. So they're not very nice taxes, but they're politically expedient. And then you have transaction taxes like the total tax that are sometimes suggested as an alternative to corporate taxes. Very briefly, the players in this, and this is where it gets interesting in terms of who's setting the tax policy. The biggest player at the moment is the OECD, who are concerned about domestic companies having a disadvantage vis-a-vis multinational firms, given that the recovery needs to come from domestic companies. I've interviewed Pascal Santaman on this, and it's clear, there's a clear motivation here. They have an action plan which is going to tidy up a lot of the more egregious kind of double Irish and things like that. A lot of those schemes, convertible debentures, they will no longer be possible in a year and a half when the OECD have been through. The other big players who are perhaps having less of an immediate impact are the UN, who focus mainly on developing countries. The EU, who have a plan which is essentially like unitary tax within the EU, the Common Consolidated Corporate Tax Base, which you don't actually hear enough about discussed in the media here, whereby companies who are operating within Europe, they will be taxed on their overall EU-wide income, and then it will be apportioned among the countries in which they operate on some proportion of their employees, their assets and their sales. Obviously that proportion matters a lot. The IMF do a great deal of research in the area, the World Bank produce reports. Meanwhile, countries in general hang on to the idea that tax is sovereign, and in Ireland in particular we hang on to the idea that corporate tax is the big sovereign thing. The 12.5% rate almost replaces the image of the harp as the thing that we hold on to. But in fact, we are essentially following or preempting a lot of these policies. So if you think briefly, and I'm stopping now, you'll be glad to know because I'm worried about time. If you think about what's happening over the next 3.5 years, if you like, this is going to be the big one. The OECD base erosion profit shifting is, there are plans to consolidate tax treaties, to obviously prevent stateless countries, to consolidate the way in which one country recognises another. So for example, in the double Irish you essentially have a Bermudan company hiding behind an Irish company so that it looks Irish from the US. That's a piece of US law. So if the base erosion and profit shifting plan is affected, that will no longer be possible. The base erosion and profit shifting plan will be affected because you've got all of the OECD countries plus the G20 countries who are outside of the OECD. You've got a very powerful group there. So this will happen. Because this will happen, you have this anticipation effect. You'll have companies and countries engaging in a period of spontaneous reform over the next few years. In fact, we've seen a little bit of that lately, not too far from here. Because it's kind of like when news is released to the market and the price adjusts. If everyone thinks Twitter is going to be an amazing IPO, then the price is, that's built into the IPO. The anticipation effect is built in. When people know that these rules are changing, they'll step before they're pushed. So, for instance, we've had a change in our tax law lately about the abolition of stateless companies, which will come in next year. That's a nice, welcome piece of spontaneous reform. And I expect we'll see more of that in the coming years. The logic is if these are cleaned up, companies in general will be paying more tax. Some countries, which are kind of maybe known as conduit countries, through which a lot of money flows, may get a smaller slice of this pool of corporate tax. That may be a smaller slice of a bigger pie, if you like. That's kind of the optimistic story. And whether or not it's a bigger pie or just the same pie rolled a bit thinner, we'll have to see. It depends on how base erosion profit shifting works out. It depends on whether companies are actually paying more tax or not. But over the next 3 to 5 years, there will be some very interesting developments coming from quite unlikely sources. And you can already see the language is changing. People are talking differently about corporate tax reform. People you would never have expected to are suddenly talking in terms of a moral argument. So it's a bit of a fly through, but it kind of sets some of the big picture, hopefully, on corporate fairness and corporate taxes.
Thank you, Sheila. We listen to some of those issues in the debate afterwards. Rodrigo Fernandez is our next speaker. He's currently working as a postdoctoral in Louvain University, and he works part-time at SOMO, which is a Dutch NGO and a member of the Tax Justice Network. Rodrigo Fernandez.
Well, good morning. I'm happy to be here in Ireland. Ireland, together with the Netherlands and Luxembourg, I think these are the three, well, problems in the European Union. I work part-time at SOMO. We lobby fiercely against the Netherlands as tax haven. There are quite emotional debates in the Netherlands. You're seen as unpatriotic if you say these things about your country. So I can imagine that there's also quite an emotional debate here in Ireland. I'm not aware of it, but I would like to learn about it. So what I would like to talk about is shadow banking. This is perhaps a new element, but we believe that it should be included in the debate on tax haven or offshore financial centers. So the previous presentation already presented the big picture. So there's this structural decline in corporate income tax. There's this mobility of capital increased in the age of globalization. Nation states started to compete with each other. So you see this process of a decline in corporate income tax. Then, next to that, we have these tax loopholes related to tax havens, conduit centers, offshore financial centers. But there's a whole debate around that. We've seen that 2012, 2013 were very fruitful years. We saw that the launch of the OECD report, base erosion and profit shifting. Also the European Parliament, European Commission, there have been debates. At the level of the G20, so that's that part, that's tax avoidance by multinational corporations. But then there's a third element, which in our opinion is not sufficiently taken on board on the debate. So in our opinion, to look only at how multinationals are avoiding tax is not enough to understand what the problems of these tax havens are of Ireland, the Netherlands and Luxembourg. And so this third element is shadow banking. Shadow banking is also an emerging concept debate since it was coined in 2007. So we have seen a lot of policy debates at the level of the US Federal Reserve, the Bank for International Settlement, the Financial Stability Board, also at the G20, and also a little bit at the level of the European Commission and European Parliament. And so shadow banking, I will not go into what it's all about because it would take me all morning, but just I will park it now as being intermediating credit outside of the regulated or regular banking system. So this includes the securitization of mortgages, but most importantly, these are activities of how or by which banks are able to fund themselves outside of the deposit taking, and mostly it is through repo markets and money market funds. And so shadow banking is about a variety of actors interacting with each other across borders. And in this network of activities, we see that a number of countries play a central role in how capital is flowing from one country, from one market segment, from one actor to the other. And these countries are in the European continent, Ireland, Luxembourg and the Netherlands. And so the types of problems they pose by doing this is different from what we see in tax avoidance. So it's not about societies losing out because there's a smaller share of the collective burden being carried by the largest shoulders. But this fundamentally has to do with creating an unsafe international financial system. This fundamentally has to do with how the sovereignty of states is being eroded, and the capacity of nation states to govern their financial system is being eroded because this shadow banking basically is about regulatory arbitrage. It is about getting across rules set by nation states. And so this is quite a fundamental issue, and we believe this element, although it is, I must admit, it is complex and vague, we must take this on board in discussing tax havens because it's completely intertwined with it. So I will not go here into the semantics of what is a tax haven, but I will basically park it and continue with the notion of an offshore financial center. So an offshore financial center basically is a jurisdiction, a country, which offers financial services to non-residents on a scale that has nothing to do with its domestic economy. Okay, so this is important to look at this, because as I already stated, this erodes the regulatory capacity of nation states. It allows for regulatory arbitrage. It allows for tax evasion and tax avoidance. So I would briefly would like to look at these figures. So the figures I want to look at, the figures that according to the Federal Reserve, to the Bank of International Settlement and so on, illustrate the size of shadow banking, are these, is this line. So these are other financial institution assets. So are they big? Well, we can debate it. They're not exploding in size, they are roughly increasing at the same size of global GDP. But they're out there, and they are, I mean, at the size of almost 60 trillion, they're a sizable market. Only these assets are not spread equally across space, they are concentrated in a small number of jurisdictions. So this is the first, this was the second study of the Financial Stability Board trying to map, like, where are these assets? And so in this study, Ireland and Luxembourg, they do not feature because they are not part of the Financial Stability Board. But you can already see basically that the largest financial centers, New York, London, of course, capture the largest part. But then the Netherlands is quite big, almost as big as Japan. It's larger than Germany and France. So this is already an indication there's something strange going on, because, well, the Netherlands, this is not logical for such a small economy of 60 million inhabitants to have OFI assets of the size of Japan. So this is in the EU, and here we can clearly see that although Ireland is not the largest player, it clearly is part of this group of Ireland, the Netherlands and Luxembourg in terms of OFI assets. So this is the same in percentage. Okay, so that was just trying to state, so we have a problem. It's not only tax avoidance, it's also regulatory arbitrage. We can capture it by other financial institutions. And these other financial institutions are highly concentrated in, if we look in the EU, in Ireland, Luxembourg, Netherlands, next to, of course, the UK. So an interesting way to understand, so why is it? How does it work? An interesting way to look at it, I would advise everybody who has the time and knowledge and interest to do so, is to look into Lehman Brothers, because Lehman Brothers, when it went bankrupt, it created a treasure of data and information, because since it was bankrupt, in all of the different countries it was active, the way it operated became public knowledge. So this is the only way, as researchers, we can really get into how do investment banks fund themselves, how do they work, what type of products do they use, how do they relate geographically. And so by looking at Lehman Brothers and other investment banks, we constructed what we call the Holland route. And this Holland route, it's a route that describes the Netherlands, but you could make also one for Ireland. And so the Holland route describes basically how Lehman Brothers funded itself through an empty shell in the Netherlands, a special purpose entity. These special purpose entities are identical to the ones used by multinational corporations to avoid taxes. The players around it, organizing it, all of the legal services provided are all identical to the ones used by multinational corporations. So basically the whole infrastructure you need for investment banks to do these types of activities is completely identical to the services you need to be in a tax haven. So that's why we believe that they are so strongly overlapping. So basically what you see is that there's the shell company but the brains and the activities, the actual people doing the work are all in London. Do I need to... How much time?
Okay.
Yeah, okay. Basically what you see is that even Dutch banks that want to use shadow banking use their London branch, but also the Deutsche Bank. Basically, it is a route to go. The American banks, everybody uses London as a base of activity. They set up a shell company in the Netherlands, and then in the Netherlands, administrative services are given by the trustees to give them a domicile, a formal, make it a formal residence, give it a brass plate, a letterbox, so letters can be sent to this place, etc., etc. And all of the administrative functions then are bought by by other banking companies in Frankfurt, London, or Switzerland. So each country has its own activity, and so basically this whole funding activity is broken down in different actors in different countries, seeking to find the best place of how to avoid regulation. And so central to this, so this is the Dutch shell company, Lehman Brothers Treasury BV, and this is basically how it operated. It was emitting notes, that's debt, and critical in how to emit debt is Ireland, Dublin. I will not go into that because it's a bit technical, but basically what you see is that the Netherlands cannot operate without without Ireland in this. They need each other to create the loopholes, to create a favorable environment. So it is actually the functioning together of these conduit havens, of these conduit centers, which enables them to act on the scale they do. Okay, so offshore financial centers, these are these centers that offer so much services that have nothing to do with their domestic economy, financial service to non-residents, which include, of course, tax evasion, but also regulatory arbitrage, are basically part of a process that has been in the making for the last 40 years. So we cannot simply think that we can get rid of it by a few simple types of regulation. I think that they are deeply intertwined with the way in which the financial system globalized. But still, what we need to find is ways to discuss this in all of the different countries that are pivotal, like Ireland, like the Netherlands, to understand its role, and also to understand the costs you are creating, and my country is creating for other countries, and the moral issues involved with this. And finally, I think that underlying these offshore financial centers, their ability to create these loopholes is this ongoing competition between these locations. And so in the end, I think that only on a larger scale, like on the European Union, or even bigger, but on the European Union would be a good start, only at that scale, political scale, I think that we can start, if we start harmonizing parts, then you can really start to see effects. Because otherwise, it will only be patchwork that creates that will always create possibilities to create loopholes to very smart planners and lawyers. Okay, thank you.
Thank you, Rodrigo. Our third speaker is Jim Stewart, Associate Professor in Finance at the School of Business in Trinity College Dublin, and his research interests are the area of corporate taxation and multinational firms, and Jim's paper is New Economy Firms and the Corporate Tax Regime in Ireland. Professor Jim Stewart. Yes.
Okay, so that was a very interesting talk from Rodrigo, and it drew our attention to the connection between low tax centres and the shadow banking system. So they often go together. So my talk is, actually I get this to work, on Ireland, is it a tax haven? Much media and other comment to the effect that Ireland is a tax haven. Government ministers, the IDA and others have stated categorically that Ireland is not a tax haven. And recently Martin Sullivan, a US tax expert, commented in a Forbes magazine article, it's a well-known business publication in the US. He says, if Ireland wants to continue to attract investment by the world's most respected companies, it desperately needs to avoid the tax haven label. It must also avoid incurring the wrath of the citizenry of the European Union, with Ireland to stop using low tax rates to steal jobs and investment from other countries. Because on to comment, we understand perfectly well why the Irish will never accept their country being called a tax haven. If we cannot use that label, we must have a term for a country with extremely generous tax rules allowed to attract enormous amounts of foreign capital. He says. It's not a tax haven, let's say Ireland is a big L. The comment from Forbes has been replicated in Bloomberg, the Wall Street Journal, the Financial Times. These are not radical newspapers. These are the kind of newspapers and media outlets that we would generally expect to support multinational companies, to be opposed to taxation. So it is, I think, we need to sit up and pay attention when large international media organisations are describing Ireland as a tax haven, never mind politicians in other countries. So, is Ireland a tax haven? Well, on one level, it's very easy to prove that Ireland is not a tax haven. Reach into your back pocket and produce a monthly pay slip. And if you look at that, you'll see in my case that on average 40% of my pay goes in tax deductions to the state in one form or another. So, as far as I'm concerned, Ireland is not a tax haven. But nevertheless, for many purposes, and for corporate purposes, Ireland has features of a tax haven. And these features are, of course, we well known: low corporate tax rates, ease of incorporation, a tax regime that is very responsive to the taxation requirements of MNCs, and relatively light touch regulation. I would argue that it's not our corporate tax rate is the key thing, it's our corporate tax regime, and it's the flexibility with which we respond to the needs of multinational companies. If they have a particular problem, they can go along and they can get a tax change. So how I might summarise that, you might say that you may all remember Garlic Man, a man who was importing garlic and pretending it was apples because he got a lower VAT rate. He should not have done that, but I understand that he paid the money back and whatever. He went to jail for 3 years. But if you take Google, what happens in the case of Google? Well, it's unlikely that Google would get into this position because they would be able to arrange, if they suddenly took it in their head to import garlic, they said, we have a problem here, we get the VAT rate changed. So it's a very flexible response to the multinational companies' needs. Features of internet-based firms, such as ambiguities in relation to location of sales and assets, enable these firms to use tax strategies which result in extremely low rates of corporation tax. Firms which are largely internet-based and firms which are intellectually property-intensive, for example software firms, are sometimes referred to as new economy firms. And this has considerable implications for tax systems, because there can be an increasing divergence between the location of new economy type activities and the location of customers and sources of revenue. This means that the principle of taxing profits where there's residence defined as permanent establishment becomes ambiguous. I might just comment on the recent OECD said we're going to do something about this. But why is the definition of permanent tax residence so difficult and so vague? If you have a shoebox over in the corner as regards the international tax treaties, that's where you're permanently resident. It's because of the OECD. They're the ones who agreed to these very wide definitions of a permanent residence. So having created the problem, and we have to remember that the OECD is made up of members and it doesn't have formal legal powers, it's a consensus-based approach. They have very wide definitions of permanent establishment because of OECD rules. So issues also arise into this, the source of value added and whatever. The issues are complex, so what I want to try to do is I want to deal with 3 case studies: Google, Apple and Ryanair, and I want to show you the effects of the Irish corporate tax regime on their tax payments. So we just deal with Google, Apple and Ryanair. I'm going to look at some of their accounts because their accounts are available, and it's very easy to get all sorts of stuff saying we're not a tax haven. Let's just look at some data and we can see what are the effects. So first point is that evidence presented to the UK Public Accounts Committee showed that Google had substantial operations in the UK, employing 1,500 and generated 18 billion in sales in the period 2006-2011. Yet just 16 million was paid in the UK corporation tax in this period. And the PAC, the UK, concluded Google defends its tax position by claiming that its sales of advertising space to UK clients take place in Ireland, an argument which we find deeply unconvincing on the basis of evidence that despite sales being billed from Ireland, most sales revenue is generated by staff in the UK. It's quite clear to us that sales to UK clients are the primary purpose, responsibility and result of its UK operation, that the processing of sales through Google Ireland has no purpose other than to avoid UK corporation tax. Now, France and Germany and other countries have other issues. We might remember that companies, MNCs operating in Ireland, operate what they call an EMEA structure. Stands for Europe, Middle East and Africa. African countries suffer enormously because of these tax strategies. A Google subsidiary in Ireland, Google Ireland, accounts for 92% of Google sales outside Ireland. Google Ireland sales amounted to 15 billion and 12 million respectively for 2012-11. Google Ireland reported a pre-tax profit of 153 million for 2012, 24 million for 2011. However, this pre-tax profit was after deducting something called administrative payments, which is mostly royalty payments, of 10 billion and 9 billion. If these had not been the deduction, pre-tax profits would be much higher. These payments are likely to be royalty payments paid to its parent company, Google Ireland Holdings. Google Ireland Holdings is an unlimited company. We don't know anything about it. It's an unlimited company, registered in Ireland, but unlimited. It's also a company what I call is bilocated. But for tax purposes, for corporate tax purposes, it's in Bermuda. Now, there's a recent state in the budget, the Minister made a statement, change in the budget, announced a change in the budget, so that would no longer allow stateless company. Google and these other companies are not stateless. They're registered in Ireland, they're legally resident in Ireland. For corporate tax purposes, they're in Bermuda or Cayman Islands or whatever, but they are not stateless. The address of Google, in fact, is given as Clarendon House, Church Street, Bermuda. So you just look at the profits of Google, and there's the point I made. You see the administrative expenses, 10.9 billion. These aren't explained at all, but they're likely to be royalty payments paid to Bermuda. And this is where our friends in the Netherlands come in, because Google used to transfer these profits to the Netherlands because there was a withholding tax and royalty payments from Ireland. So they went from the Netherlands to Bermuda. It's called the Dutch sandwich. If you're bilocated, it's called it the double Irish. But it's really, I think, simpler than English, bilocated. Now, foreign withholding tax is 17.4 million, so you're not even sure the tax shown in their accounts is received by the Irish Exchequer. In fact, it's the tax charge, might not actually be the tax payments. So the effective tax rate from their accounts is 21.86%. If you ignore the royalty payment, is 0.3%. Effective tax rates are determined the definition of administrative expenses. What are these administrative expenses? So what are the implications? Well, Google in its SEC filings, it states, although we file US federal, US state and foreign tax returns, our two major tax jurisdictions are the US and Ireland. Substantially all of the income from foreign operations is earned by our Irish subsidiary. So the Irish subsidiary is Google outside the US. And that shows the profits and effective tax rates for the Google group. And one of the things I want to draw your attention to is that they do pay tax. There's the tax charge you see shown in the P&L for 2.6 billion approximately. The actual cash tax payment is lower than that, but they do pay tax. But the foreign tax, you see the foreign tax charge is 358 million. So Google pays tax, but it's in the US. Google does not pay tax outside the US, and that's the problem. And Ireland facilitates non-payment of tax by Google and other companies outside the US. So, the actual tax charge outside the US, this is the tax charge in their P&L. In fact, it's likely to be much lower than that, the actual cash tax paid. So let's deal with the next case study. The US Senate report on Apple Computer Permanent Subcommittee investigations found one subsidiary located in Ireland, Apple Sales International, had no employees, but had an income of 22 billion in 2011 and paid 10 million in tax. This is Apple Sales International located in Cork. This compares with income before tax of the group as a whole of 108 billion in 2011. Tax payments shown about 14 billion or whatever. The US Senate report groups Ireland along with Bermuda and the Cayman Islands as a tax haven. It states that Ireland has essentially functions as a tax haven for Apple, providing with minimum income taxes pushing zero. This led to a letter from the Irish ambassador to the US Senate Permanent Committee and Subcommissions saying that Ireland was not a tax haven, and they replied to the fact that Ireland is in fact a tax haven. So the data produced by the subcommittee is very, very interesting if you're interested in these things, because Apple Sales International produced accounts in 2004. 2004, they changed into an unlimited company. So you didn't know none of the Apple subsidiaries in Ireland, there's no data available from them at all. The last set of accounts showed that pre-tax profits amounted to 345 million, that's a lot of money, but by 2011 it increased to 22 billion. 345 million, the tax charge, the tax charge in 2004 was shown as 20 million. Profits increased to 2011 to 22 billion, and the tax charge halved to 10 million. So this is very, very interesting data because it just was not available in Ireland, and we can see the effects of Google Irish operations. So we look again at the global position, similar to Google. Apple does pay tax, but it's in the US. Apple does not pay tax outside the US, and that's the problem. That's why the UK and France and Germany are very angry about the Apple operations and the Irish tax system. So numerous companies are operating in Ireland use a bilocation strategy, located for corporate tax purposes in a tax haven, low tax regime, such as Bermuda or the Cayman Islands. The difference between Apple and Google is that Apple said we're not located for tax purposes anywhere. But they could easily say we're located for tax purposes in Bermuda. It's exactly the same effect. Outlawing the stateless thing is meaningless unless you also remove the bilocation strategy. This is just a figment to say, or just a soft to say we're outlawing the stateless capacity. The case study I now want to talk about is Ryanair. Complex corporate tax structures and ambiguities related to location of sales and assets are not just limited to new economy calls. Remember Amazon. Amazon doesn't pay any VAT because Amazon says all its sales come out of Luxembourg. So that's why bookshops are shutting down all over the place. They pay VAT. Amazon does not pay VAT. Starbucks, again, pays very little corporation tax in the UK. So effective corporate tax for Ryanair are far below statutory rates. Corporate tax payments for 2007-2013 amounted to 95.8 million and profits at 2.7 billion. An effective tax rate of about 3.48%. The other interesting thing if you look at Ryanair accounts is that employer PRSI costs are also very low given their operations are based in countries with far higher employment PRSI charges than in Ireland. So the OECD shows that the contributions on average in Ireland are 9.7%, varying between 16 and 29% in the countries where Ryanair operate. In fact, if you look at their accounts, the amount that they pay in PRSI as a proportion of employee wages is about 4.4%. And these arrangements, and in fact, why did they do this? Because they claim that a lot of their pilots, for example, are employed by a company operating in Ireland. This company they own, and as they're self-employed, the PRSI would be 4%. Now they may be operating in Charlotte or whatever, but this is what they say. This is their claim based in Ireland. As a result, there are tax cases being brought against Ryanair in Belgium, Italy, France, and the UK. So, and these arrangements have been agreed by large cases division. Sorry, just can't get the next one to work, but it just had some this just stopped working for me. So here it is. So that's just the data for now. You see the PRSI over staff cost 4.6 million. One interesting thing about this data is that Ryanair, even though the number of employees has increased from approximately 5,000 to 9,000, the amount they pay in PRSI is around 18.1 million. So they seem to have this target, they seem to have been able to hit this target to very tight budgetary and other controls. So US Bureau of Analysis shows that effective tax rates for US-owned companies in Ireland are about 3.3%. However, for many firms it is zero because they're resident for tax purposes in no tax regimes such as Bermuda. So let's just think about some of the implications. The corporate taxation rate in Ireland for bilocated companies is irrelevant. The corporate tax rate in Ireland could be 100%. If you're paying your tax in Bermuda or Cayman Islands, it doesn't matter because that's the tax rate. The Bermuda or Cayman Islands tax rate is the appropriate one. Tax reduction strategies are common in old economy firms as well as new economy firms. These develop some considerable adverse implications for the corporate tax base in Ireland and elsewhere, as well as for other taxes such as PRSI and VAT. No matter how carefully I searched the Ryanair accounts, I could not find the words value-added tax or VAT anywhere. Additional factors, why did Ireland become central to the tax reduction strategy of so many firms? The main reason is on tax-based industrial strategy, a tax-based industrial policy. Additional factors are, of course, competition between states and an equal bargaining power between revenue authorities and large mobile international firms. There's little official recognition from the government stage that there are features of the tax regime in Ireland that other countries regard as harmful. The response of the Irish government to the Permanent Subcommittee investigations is that Ireland is not a tax haven because there's no possibility of individual special tax rates being negotiated, and because none of the tax indicators established by the OECD apply in Ireland. The OECD does not identify any country in the world as a tax haven. No country is a tax haven as regards the OECD. I think Vanuatu had a problem for a while because they don't have the civil servants to fill out the forms to show that they're not a tax haven. They came out of Bermuda. None of these are tax havens. Others have argued that it's unfair, if not hypocritical, to regard Ireland as a tax haven, and there's all sorts of other things. Excuses that they're US companies, it's the US problem. Five located companies are only allowed for their group operations. All countries must change under Ireland. The OECD is the only viable solution. And of course, as already mentioned, get rid of corporation tax. It's difficult to tax, so get rid of them. And if you get rid of corporation tax, you get the tax down because companies increase their investment, increase employment, and they pay VAT and income tax and all sorts of stuff like that. Right, conclusion. So the focus has been on US firms, but ES-based firms are also extensively involved in tax minimisation strategies, including in Ireland, for example, Cadbury, Vodafone, SAP. German companies, especially the Netherlands and Belgium, as part of complex tax arrangements to minimise tax. Tax avoidance strategy resulting in narrowing the tax base of constantly reducing tax payments for those firms and sectors unable to avoid tax. So if one sector does not pay tax, then it's shifted onto the other sector. The sectors that are immobile, individuals, companies, SMEs that cannot shift to other tax base. So what's required? Well, we need greater transparency in relation to sales and tax payments by firms operating across countries. The accounting directive. Companies should be required to show their sales and profits earned in each country where they operate. We need increased cooperation across countries. We need far greater tax harmonisation. I'm in favour of a harmonised corporate tax base. We need new sources of tax revenue, for example, a financial transaction tax. These developments, and the OECD have said they will take place, the G20, the G8, is a considerable indication for largely tax-based industrial policy, as in the case of Ireland. But they are necessary to ensure a more equitable tax system in terms of taxing highly mobile capital, both corporate and individual. We have to remember that individuals, very, very wealthy individuals, don't pay tax in lots of the countries where they normally reside or are assets. And that's a huge problem for the tax collection systems of all countries. Thank you very much.
Sorley McCaughey of Christian Aid would like to.
I want to just make some comments on the impact of international tax practices on the global south, which I think is appropriate. We have our own issues here regarding trying to make up the deficit between our budget requirements and what we have, and that has put the focus very much onto tax issues. But clearly the issue in the global south is much more profound, and the implications of tax avoidance and tax dodging are much more serious. The extent of the problem is hard to measure. I mean, the nature of the problem is that it's difficult to get hard facts. There has been lots of research carried out on what the extent of the problem is. Christian Aid has conducted research to show that every year $160 billion is lost to the poorest countries in the world through transfer mispricing between related companies. And that's probably just the tip of the iceberg. That could be revenue that could be spent on basic services, essential services and infrastructure and things in developing countries. It also prolongs countries' reliance on aid and leaves them dependent on donors and skews accountability away from citizens and towards multinational companies and to donors, which is a situation that is certainly in the development sector is one that we want to get away from. But really, numbers, it's not really about the numbers. I think what we can all agree on, and certainly the OECD would support this and take this line, is that developing countries are losing more to tax avoidance than they're receiving in aid. So for that reason alone, in terms of efficiency of our aid money that we're providing to developing countries in our aid cooperation, that's a question of aid effectiveness as much as anything else. To get to the meat of it, is Ireland complicit in this? I think the answer is yes. There are two pieces of research that have been conducted over the last few years that would show that. In 2008, Christian Aid's conducted research, carried out a report called False Profits. It showed that between 2005 and 2007, 5.8 billion worth of capital flowed into Ireland from the same kind of transfer mispricing that I refer to. That's just inflating or deflating the price of a traded commodity between related companies to either minimise profit in a certain location or maximise it in a certain location. Of that, 268 million came from the poorest 49 countries in the world. More recently, a report from ActionAid called Sweet Nothing showed that through in part the use of a brass plate company in the IFSC, Zambia lost $9 million between 2007 and 2010. Zambia is an Irish aid programme country that we have supported for decades now. So there's a very real issue of policy coherence between what Ireland is saying on the one hand in terms of their development aid and the reluctance or inability to take action on international taxation issues. What are we calling for? We've been calling for a long time for the introduction of greater disclosure and greater transparency from both multinational companies and from states. From countries, as Jim has already alluded to, we want to see greater disclosure in the practices of multinationals in each of the jurisdictions in which they operate. So that goes beyond sales made, profit made, taxes made. It looks at the assets held, it goes to and employees and the full spectrum of activities that a company is involved in. Only then do you start to get a full picture of what a company's activities are. And you might begin to get the first inkling of whether or not illegal profit shifting is taking place. Indeed, legal profit shifting in many cases, but at least you'd have the information then to tax it appropriately. The second thing is we want greater exchange of information between jurisdictions on their tax practices. At the moment, most of that is done either on a request basis. We want that done on an automatic basis, so that when countries are have a sense that there might be something untoward happening in the tax practices of a particular multinational, they don't have to go through a very tedious and legalistic process of making a request for information from that other jurisdiction. That is a tedious process in itself, and it is beyond the capacity of most developing countries. We want, and I'm happy to say that most of the international institutions now globally recognise that that should be and is the gold standard for information exchange. It should be done on an automatic basis. What we're going to do about implementing that and getting that actually to happen is the next step. The third thing and final thing from what we were asking for is around beneficial ownership of companies. At the moment there's phantom companies around the world which are owned in name by solicitors or accountants, and you don't actually get to know the true flesh and blood owners of companies. At the moment there's a directive working its way through Brussels as part of the anti-money laundering directive that's looking at the issue of beneficial ownership of companies. We're calling for a public register of the true owners of companies. Only then do you start getting a picture of whether or not this company is owned by somebody who may or may not have been the beneficiary of tax avoidance measures. That's something we're lobbying very hard with the government at the moment. The final thing I wanted to say is in 2011 the G20 commissioned a report looking at domestic resource mobilisation for developing countries, and as part of that report there was recommendations made to G20 countries, and you can argue the bit over whether Ireland is a member of the G20. I believe it is by virtue of its membership of the EU. And that recommendation was that they each G20 country carry out a spillover analysis of its tax policy to ensure that it's not detrimentally impacting on developing countries. We have asked the Minister for Finance on numerous occasions whether or not he's prepared to carry this out, and to date he has indicated that he's not willing to do that on the basis that Ireland is not a member of the G20, therefore it doesn't apply to us, which I believe is a highly unsatisfactory response to that question. Finally, I would agree with Jim regarding his definition of tax haven. In a way, it's not particularly helpful because, as he said, Nobody's a tax haven according to the OECD. But I think we must be looking at it in an Irish perspective, for the perspective of developing countries. Is Ireland's role in the international financial architecture having an impact on developing countries? And the answer is yes. And that is really, I think that's the starting point. To conclude, it is an international issue, and there are elements of the international financial architecture that obviously need to be addressed at an international level. However, the responses that we get and listen to in the media, which is that Ireland, that the issue is an international issue, I think is an abdication of responsibility on the part of the Irish government. As I've shown, there are very key things that Ireland can do unilaterally and in its own right to demonstrate, as they so often say, that they are champions of transparency and exponents of the highest standards of transparency and disclosure. So, thank you very much.
Thank you, Sorley. We now have an open debate. Any questions to either the total panel or to individual speakers?
The two short questions. Corporate profits in the US are at the highest level in 50 years. Surely this should mean that the level of taxation should shoot up as well.
Comments?
Especially with all the US companies in Ireland.
Yeah, sure. I guess it's quite difficult to relate where the profits are, where the tax is paid, even from accounts. And I noticed that in this little couple of years doing a PhD in tax, the tax charge in the accounts doesn't necessarily relate to tax payment because you've got deferred tax and all kinds of accounting fictions mixed in there. Accounting profits in the US are probably on a consolidated basis for the company, so you're looking at the ownership company. So you can see these are the profits that US multinationals have made. They would argue where they made them and how they made them by some shockingly productive people managing loyalties in some flexible jurisdictions rather than by, in the places. Like you take an iPhone, like there's a certain amount of design in California, there's a whole lot of painful manufacturing in Foxconn in China, and then there are some quite well paid but very productive people who manage royalties in jurisdictions that have nothing to do with the actual movement of the technology or of the product, and that's where the profit gets generated. So it's the fact that multinationals have shifted the location of their profits away from the real activity into either low tax jurisdictions or places that in combination practically eliminate tax. That's why you haven't seen that kind of thing, and that's why the OECD are a bit bothered by this suddenly.
Rodrigo?
Well, yeah, I think the answer was quite clear, and I think that it is one of the problems. I mean, for instance, tomorrow I'm going to go to a seminar of the Dutch Central Bank that is going to discuss exactly this. That is the problem of multinational corporations having historically high levels of profit. These profits are being shifted. They end up in locations where they are untaxed, but then they have difficulties. They are accumulated on locations where they cannot be easily be reinvested in the economy. So this business of avoiding or evading taxes leads these profits to jurisdictions where they cannot be reinvested in the economy. So this creates a problem of its own. Jim?
We should note, of course, that the US gets about 10% of its total revenue from corporation tax, and this is higher than a lot of other OECD countries. The question is, why isn't it even higher? And if you like, the US has an option on these profits. If they're repatriated to the US, they get the tax. If they're not repatriated to the US, they're to the benefit of US companies and to the benefit of their employers, who are largely US based. So I think even though companies in the US do not pay a tax of 35%, no company does, the US still benefits very much from their tax regime. It's people outside the US, because of Google and Apple, tend to lose out.
Second question.
Microphone is coming.
Yeah, a quick one again. Sheila, you mentioned that on the far right is the Oxford Centre for Business, and you just kind of dismissed them. But the Department of Finance had a seminar recently, and a key speaker was Mike Devereux, who's head of that body, and he advocates that companies shouldn't pay corporation tax. And the Department of Finance were very deferential to him, and in fact they said that they use him quite a lot. Should we as citizens be worried that our Department of Finance is getting such advice?
I suppose I didn't mean to dismiss them, because they are very influential, as you say. So I don't mean to dismiss them as unimportant in that respect. It would take a bit of time to go through the many reasons why they're wrong, and they are also. It is a very worrying kind of a policy. So anyone should be worried whose government are buying into the idea that we shouldn't tax corporations, because corporations consume resources in a jurisdiction, and if they're allowed to back out into the situation where their contribution to the coffers is, well, why would you tax us? Aren't we employing your citizens, and look at all the tax they're paying, and they kind of claim credit for the it's an increasingly common thing. You'll hear it. Multinationals who operate here are saying, well, you know, we did pay a lot of tax here. Look at this tax, and you look at it, and it's the tax that's paid by the employees and the PRSI. They didn't pay that tax. Their workers pay that tax. So we shouldn't be so grateful for their presence here that we're really thankful they've employed a few people who will themselves pay tax. If they're generating activity here, consuming resources, using the infrastructure of security, education, transport, broadband, etc., then they should contribute for that. So I didn't mean to dismiss them as insignificant. They're just terribly, terribly wrong.
Yes, can those who want to ask a question or make a point covet the unused microphone, and they can wave that at me. And I'll get to all of you, and then I'll call them in. Yes.
Hi, Tom Kivlan here. Was there any study done on the relationship of three different taxes, rather just on corporate tax alone, when you add together income tax and capital gains tax within companies? If you look at the United States, they have a high corporate tax rate, but when dividends come out or the distributions of profits, it's quite low compared to this country here, where it would be at the full tax rate. When you distribute profits from a company, if it's a high tax rate on its corporate tax rate, and then high when it comes out as income, because really what you're doing there is distributing the income of the company to the owners of the company as shareholders. Surely that whole relationship between the three of those, between capital gains, corporate tax and income tax, should be looked at in the whole, and what each country does within the whole there.
As luck would have it, my PhD looked at a difference between the classical and imputation systems, which is where income that comes from companies is or isn't, does or doesn't get a credit in the hands of the person who receives it for the tax that's paid by the companies. And I looked at a change in the UK. But in a way, dividends come out below the line, and the way in which companies behave is very different when they're differently motivated, and the way in which investors behave. And the piece of research I did, which was kind of a long time ago and wasn't great, to be honest with you, showed that US pension companies, their investment patterns are different when they're taxed differently. So the thing is systematic. Companies and investors, and institutional investors in particular, like pension funds, will behave in pure rational economic manner in response to the tax rules, which is why the rules matter. The rules really matter, and the interaction of them really matters, as you point out, because you can talk about how individuals are taxed on dividends, but the biggest investors worldwide are pension funds, and pension funds will be taxed differently. And they'll be taxed differently in different jurisdictions. So there's a kind of a hopelessness about individual countries trying to capture tax from companies that are almost flying overhead. It's like air traffic control systems. If the Irish air traffic control system weren't talking to the UK one, I'd be a hell of a lot more worried about a flight I'm taking later today. Like the countries need to have free and spontaneous exchange of information, as Sorley said. And in order to do that, you need to line up their IT systems, because we have a situation in Ireland where we say the social welfare system and the tax system can't even be married together particularly well because the information can't flow. And they must be as compatible computer systems as you can come across. So there's a whole lot of infrastructural support that needs to go in, particularly for southern countries, in order for them to even avail of this kind of free information flow. So you need a lot of international political will, which is probably why the OECD, in spite of the fact that people might love them less than they love, I certainly love the UN a whole lot more, but the OECD have the money. So the OECD BEPS prospect will probably make a huge difference in that respect.
Okay.
Can I just comment?
Yes.
Most dividends paid by companies are not taxed because they're paid to another company outside the jurisdiction and there's no withholding tax. Capital gains tax is not paid by most companies because they can defer it in Ireland by investing in similar assets or elsewhere. Dividend income, the taxation of dividend income is complex, but I suggest to you that the very wealthy who hold a lot of their assets in corporate form do not pay tax on dividend income because they're able to avoid this tax by tax strategies.
But all the time we're talking about legislation and the expectation that international regulation and legislation can change. Skinner, you know, the psychologist says behavior is determined by its consequences. If you get a better dividend for an international company or for a pension fund, they will use the rules that are there. So you're talking about a change of culture, which you would love to see, but you may not get that. It has to be a change in law, sure.
I think you need both, because like you take companies like Amazon or Apple, or they talk in terms of corporate responsibility. And if you take, say, Starbucks, they talk in terms of corporate responsibility. And we all sit here happily saying, oh yeah, well Starbucks, they're responsible for them. They should buy fair trade coffee. And we don't think there's anything illogical about them paying a little extra for the coffee. And there isn't. They should buy fair trade coffee. And so they do. Tax is the essence of citizenship. It's the essence of belonging in a society and making a contribution. If a company is really responsible, then it should pay fair trade tax. That might mean paying a little extra, but not actually doing very bad things to the world in the prospect.
And as a gamekeeper who's become a poacher, if I may put it that way, since your previous work was within that sector, what's your view of the likelihood of change in legislation?
I think there'll be change in both. I had some really interesting conversations about a year ago, and there was a committee of experts meeting in the UN, and there were a lot of people there from NGOs, from the UN, from the OECD, the IMF, and they're talking about corporate taxes in the context at the time of the extractive industry, but BEPS, the OECD initiative, had just come out. And people who were advising big firms, people from the US Chamber of Commerce, people who manage tax for the likes of Exxon and Shell, were over coffee. Like the phrase that sticks in my mind is one of them said, I mean, all of a sudden all this is supposed to be wrong. But they were saying that, and they were thinking like, damn it, you know, I'm going to have to rethink how I'm at least presenting myself to the world, which is like corporate responsibility is kind of a 5-step evolution, and at least the first step is
and
how I present myself.
There's vanity involved in it as
there
well.
Is, there's image.
Can I react to that?
Yeah. Yes.
Because the Tax Justice Network is not a unity. There's different opinions, and of course, this is an ongoing debate on corporate social responsibility. And my personal opinion is that it is a bit of a dangerous route to take, because of course it should be part of corporate social responsibility, CSR. But I see CSR as a it's in the end you're asking a sort of a voluntarily multinationals to become responsible. Yeah, but I think that it in the end we need to have a legal framework which makes it impossible, illegal, or expensive
to do these kinds of things. And that is we need to have effective regulation, and not to start with the multinationals, but start with the states, with the politicians that should ensure that those rules are in place. I think that is the starting point. And the companies, well, they are acting within the rules. Of course, they are doing everything they can to create these loopholes. But to start with corporate social responsibility is I think it's a dangerous route.
I think you need both. And if you go back to the fair trade example, it wouldn't work if you didn't have the ILO, the International Labour Organization, hammering out painstaking and relatively bulletproof labour standards. But fair trade has made a big difference to the standard of, say, coffee that we consume. So I think there's room for both here. I think it's hypocritical in the extreme for companies to call themselves socially responsible while aggressively avoiding their taxes.
Okay. Whoever has the mic, basically. Yeah.
Thank you. In terms of where Ireland stands in all of this, both domestically in terms of what we have control over and our contributions in the international arena, just be interested in getting the opinions of the panel on what was announced on Budget Day, our corporate tax strategy. Is it just another attempt to jump on the bandwagon, as you said, Sheila? Or are there any nuggets in there? Is there anything in there that could be built on to reform our corporate tax strategy?
I think that it's very complex, because we've embarked on policy, industrial policy, just tax-based. Every budget has changes, and the finance bill has even more changes of complex changes that affect maybe one or two firms. And we have to remember that the tax avoidance industry is very large and powerful, that they constantly lobby for change. The big four firms for 2012 had over 20 billion in revenues from tax advice. They're very powerful organisations. So I think we need to change from a tax-driven industrial policy. And I think that we need to try to develop in a way that isn't necessarily involved in giving tax breaks to individuals. But that's going to take a lot of change, and there are other things going on. So I don't see much. I did not see much in the budget. I can see that the negotiations, for example, in relation to the formation of a new German government, could be very key in the case of Ireland. Other EU negotiations and EU debate taking place could be very, very important. I'm not so sure about the OECD, because the OECD represents the very wealthy countries, and within those countries, large multinational companies, the tax avoidance industry, are very powerful indeed. So I'm not sure that the OECD might have some moves in some direction, but I'm not sure. But certainly individual countries whose tax base is suffering because of tax policies in Ireland and the Netherlands and Luxembourg, and we have to remember that the Channel Islands and other countries, that I think pressure could come from there.
Yes. Yeah. Here we are. Yeah.
My name is Alfred Toller. I'm from Google, and so I will jump back to the social responsibility part, and because I think that's a very important part in this whole discussion. I remember when our vice president was questioning by the House of Parliament in the UK, and the logic behind our argumentation, and I see that in a lot of multinational companies, is that saying, look, as long as the politicians are providing these loopholes, we need to use these loopholes as a competitive advantage against others. So what would shareholders or stakeholders say if we won't do this to others? That is the argumentation, and I see that you can argue both ways. And if you're going along those lines and saying, okay, here are the practicalities, here's why this is not true, this is, you're probably going back and forth. And even though I think it's very important to establish a legal system which is unified and where everybody is behind it, I think that this will probably take a long time down the road to achieve this. So social responsibility is, from my perspective, maybe much more powerful, because in wherever countries I am, I see that we don't have money anymore, even in Germany. I'm German. So even in Germany, we don't have money for hiring teachers, for school systems, for nurses, for our health system. So all this stuff has been, there's no money for that anymore. And there is an inconvenience for people in saying, why is the government not able to fill these holes? So I think social responsibilities should become a much more broader topic, which is not based on technicalities in saying what kind of law should be applicable and where shall we change it. It should be, how do we use tax, and what is the responsibility for whom to the society? I think that is the discussion we should make, and that's what I see is much more powerful, especially in times where we have digital platforms and where we can gather a lot of people against this. And I see already, when nothing happened in these lines, that political situations becoming unstable in a lot of countries, and the right as well as the left-wing parties take advantage on this one. So I think it's a much broader topic, and social responsibility, for my part, takes a lot of, is a big component in this.
Yes, Sorley, yeah.
Just in response in part to what Sheila was saying, and to the gentleman from Google as well, and it's the issue of the morality of tax, and whether that is a discussion. I agree with Sheila that it's both. It's a cultural shift and it's a structural shift as well. But I think it's interesting that there is the beginning of a cultural shift certainly in Britain, and I think more internationally. And there was a legal opinion solicited from the company, the eminent legal firm Farrer and Co., who list the Queen amongst their clients, that notable tax avoider. And the question to them was whether or not it was the fiduciary duty of board of directors to minimise their tax as part of their obligations to their shareholders. And the response was, it is not possible to construe a director's duty to promote the success of the company as constituting a positive duty to avoid tax. More than that, they say that board-level executives often benefit from performance-related reward packages which are indirectly affected by the amount of tax the company pays. Corporate tax avoidance is presented as a matter of high-minded fiduciary duty, but it is probably better understood as being about personal reward.
Can I just get back on that briefly? I think it's important to remember in all of this, not all companies are tax aggressive. Not even all multinationals are tax aggressive. So if you're talking about social responsibility, with all due respect, most companies aren't benchmarking off the level of tax that Google are paying or Apple are paying. Many companies take a much less aggressive approach to the management of their taxation than them. Johnson & Johnson used to make all of their decisions on location on a pre-tax basis, and then they look at tax afterwards. And when you look at case law, you can go right back to the Duke of Westminster, which held that everyone has the right to arrange their taxes and affairs in ways to minimise taxes. We have evolved since then, and the level of duty that directors have to their shareholders is for the long-term stewardship of the company. And the long-term stewardship of the company isn't just how much you can get away with this year. It's what's going to explode on you in a year's time. And we've seen it explode for many of these companies that have been in the news. So I don't want to overplay the socially responsible thing, because I agree with Rodrigo. You need law and you need international law. But you just simply can't say that you're socially responsible if you're saying we're going to pay as little as possible everywhere possible. That's just not socially responsible. That's not what most companies do.
But when you say, Sheila, that it can explode on you, that depends on the service or product that you're in, that is your line of trade. Obviously, if you're selling coffee on the high street, or you've got a franchise within a firm,
or you have a personal interface with your customers and recognise
you're
them.
more vulnerable because if a couple of people in a firm say we're not taking coffee in the canteen, we're boycotting it unless it's fair trade, the leverage is multiplied and you get a quick decision.
Because if you make a little plastic component that goes in a car battery, you might think, well, it doesn't matter. But
no, I'm not saying it doesn't matter. I'm saying the leverage available to you is less.
Sorry, no, I do understand what you mean. But that's where supply chain issues come in, because then eventually that'll explode on Kia or Ford or whoever is using that thing. So that's why all companies eventually get it.
I think it is very important. I mean, it's very nice that suddenly there's an interest in austerity-related problems. I mean, that's very good. But we need to put it in context. So what you see is that the breakdown of the Bretton Woods system, the post-war international architecture, how capital became mobile increasingly from the 1970s, the waves of foreign direct investment, mostly mergers and acquisitions in the 80s, mostly in the 1990s, this whole led to companies that were first operating on a national scale to merge and become multinationals. So the share of the world economy that is being produced, traded, controlled by multinationals increased from the 1970s now from less than 12% now to more than 60% trade, 80% of world. So being a multinationals, the world economy being dominated by multinationals now more than it was before, creates the conditions, the ability to evade taxes. And so this is also reflected through the capital flows flowing through, for example, the Netherlands, that from 1984, when these tax evading structures were made legal, it started out with a few million pocket money. What you see in around 2000, the money going in and out of the Netherlands is already roughly 2,000 billion, 2 trillion. I mean, the GDP of the Netherlands is 500, so that's 400% of it. In 2008, it was 12 trillion. It's almost the size of the US economy. So what you see is that we are seeing a historical process where the amounts flowing through multinationals being used to evade tax is only increasing, and it's going to levels unprecedented. So at this stage, to be saying, yeah, well, there's a problem and we should leave it up to a voluntary basis of multinationals to do the right thing because politicians will take too much time, I think that is a very dangerous route.
And Rodrigo, in giving the figures you gave for different European countries, and the Netherlands, would it be fair to say that the Netherlands, leave Luxembourg out because proportionately it's so tiny, just for that reason only, but compare the Netherlands with Ireland, is the Netherlands kind of 3 or 4 times worse?
Much larger. The Netherlands is much larger in terms of foreign direct investments flowing through the Netherlands, but it is not only about volumes, because these are conduit structures, so they basically enable capital to flow to other jurisdictions, just like Ireland, but Ireland is much more effective in some corporate structures than the Netherlands. So simply, well, it will be a bit technical. The reason why the Netherlands is so much larger is because the Netherlands is used much more for interest structure, so lend in, lend through. And
that is historically based? Is that they had the opportunity and they exploited it? Are you saying the other countries didn't have the opportunty, or that they have a better sense of responsibility about this agenda? Ireland,
as far as I know, it was a strategy, an industrial strategy with the Irish Financial Centre. The Netherlands, of course, has got a much longer history and tradition in
banking,
doing all sorts of dodgy things in history. I mean, it's an entrepot economy.
We have that at the Boyne next.
I mean, it is very much related to the rise of the multinationals, mostly Shell, Philips, in the late 19th century, and because of the colonies of the Netherlands. So the rise of these multinationals on a very early stage led to the need to create an international tax network to help the Dutch multinationals avoid paying double taxation. So that's why there's very deep roots.
Okay. And just in relation to that question, the Netherlands is the largest most important country in the world for the taxation of financial income for US multinational companies, and probably for other companies as well from different other countries. Ireland is the largest single location of real profits from foreign direct investment rather than financial investment within the Eurozone and probably within a lot of other countries, certainly within the Eurozone. That's where profits are declared. So if you're a financial company, you make profits in the Netherlands, and that's because of their holding company legislation. And what Rodrigo didn't like to say actually, because the Netherlands, why do they do this? Because they're very skillful. I mean, they have really skillful lawyers and tax accountants, very clever people there. For years they've been able to get away without being a tax haven, while being the biggest tax haven in the world. That shows the skill.
Yeah. Sheila?
Just awfully briefly, I mean, Rodrigo is completely right about the fact that I don't want to overplay the responsibility thing. I just think there's a hypocrisy there that is worth pointing out. And the reason why the Netherlands are successful and Ireland are successful, it's kind of consistency. Companies like consistency and non-volatility in their earnings. So regardless almost of who comes to power in Ireland in the foreseeable future, you can tell that the corporate tax policy is not necessarily going to change. There are other countries where the current government have a policy, but there is an opposition waiting in the wings. So that makes the Netherlands or Ireland a more stable exemplar of their tax policy than other countries. That's why they're successful.
Another contribution.
Thank you. Two quick questions. The first to Sheila and Rodrigo. Sorry, my name is Nessini Cossada and I work for Debt and Development Coalition Ireland. First question to Sheila and Rodrigo. Research we're engaged in at the moment is showing that European Union governments do not see the UN as a relevant body for policy decision making in this area. What is the value of us really focusing from a campaigning perspective of shifting that focus towards the UN as a relevant and valuable vehicle for decision making in this regard? Second question.
No, we'll take the second one later.
Okay.
Just stay on the UN one first. Do you understand?
Well, the UN has, of course, has different. I don't know where you are, but the UN, of course, has different bodies looking into this, and it's very complex decision-making UN, of course. But at the moment, I forgot the English name. The social and cultural rights. How do you call it? Well, the Treaty on the Social Cultural Rights. This is something that is going to be looked in the June 2014. There will be a report given to this commission. So this is of course a not binding, like everything in the UN, very soft. It has no real meaning, but well. It would be the strongest denouncement at the moment if they could start looking into, because they look at developing countries mostly, and they will be looking into the tax treaties they have with, for example, Ireland or the Netherlands. Tax treaties, I think, are the way, and to look at coherent strategies, how development strategy is coherent with these tax treaties. This is the place where the UN bodies become relevant. So the developing countries part, and specifically the tax treaties. Because these are the legal hardcore documents. This is where things can be changed, and these are treaties that have actual effects and that can be simply debated in Parliament and be problematized. So I think that if you talk about the UN, it's about tax treaties that they will be the most relevant, I think.
Just awfully briefly, I think the biggest difference for me between the OECD and the UN is like the difference between democracy and money. So the UN is a very representative body, and they're slow and cumbersome and bureaucratic, and when they work something out, it's got international buy-in, really international buy-in, like properly all the countries, whereas the OECD is a club of rich countries, and when you add on the few from the G20, that makes the BEPS project something that is run by a small number of rich countries, but rich countries have the money, therefore they will be able to give effect. So I think the only problem with the UN is that it's really under-resourced and it's a bit slow-moving, but it represents the voice of actual individuals who are affected by all of this. I mean, we can gripe about having to pay the debt or whatever, but kids in Zambia don't get to even gripe about it. So if you want to actually address this down to its fundamentals, then you've got to involve the UN.
So your second question?
Thank you. Short question to Jim. What are the specific steps our Minister for Finance should take in order to make the announcement in the budget about tackling stateless companies substantive and meaningful?
I think the Minister has to do something about the double Irish. Now, we noticed that there have been various statements in the press from the man working for PwC saying that the double Irish was finished. But yet, I noticed in the papers that more and more companies are locating in Ireland because of this EMEA strategy. That is, that they base their sales on their sales route to Ireland, and they probably have a bi-location strategy to Bermuda and Cayman Islands. So I just see a disconnect between the industrial policy, these companies are still locating here and they're setting up an EMA, and what the Minister says. I think this is a very dangerous industrial policy, by the way, because if the tax changes, do these companies leave? Google employs, I think it's 3,000 people in Ireland, 50 different languages spoken there. Where do they get these people? They have to come into Ireland to work here. Ireland, we're notoriously bad at speaking languages. There's a shortage of computer skills. And again, a lot of people have to come into Ireland to provide these skills. So the danger for Ireland's industrial strategy is if the tax system changes, will Google move its locations to France, move back to the UK and other countries where it has its sales and revenue? And the same thing applies to lots of other internet-based companies, PayPal, LinkedIn, all these, Twitter, all these companies are located in Ireland, the EMA strategy. So I think industrial policy, as I said, maybe needs to change. It's not really a statement in the budget.
Right, we'll take a final question before the coffee break. Just two questions, both of these. Yeah.
Hi, Colin Roach from Oxfam, Ireland. A layman's question for Jim. When Apple and Amazon, etc., claim not to take revenue or not to generate revenue from the UK through their sales, what's to stop HMRC from simply disbelieving those claims and slapping a tax bill on them? Is it a legislative problem or a legal problem, or is it a cultural problem?
That's an interesting and a very good question, because I think, given the evidence given to the PAC by Google, that there is a good case, and the PAC and that apparently the HMRC have been getting a lot of information related to Google operations. The UK could say those sales really take place in the UK, and hence the profits take place in the UK. Will the UK do that? And what about Amazon? It's extraordinary that Amazon is able to claim that all its sales take place from Luxembourg, even though they're all located in the UK. I think HMRC has got far too close to big business. The HMRC is, in that sector, talking about a large cases division. And all OECD countries have... Her Majesty's
Revenue Commissioners.
Her Majesty's Revenue Commissioners.
I thought it was a new multinational for a minute.
So the Revenue Commissioners are on a large cases division. This large cases division is very close to these multinationals. Paying corporation tax is very complex. So the idea is you got up close to these companies and you negotiate with them and you sort out any problems so that they pay the tax and avoid aggressive tax avoidance. However, it leads to all sorts of issues. And the recent report by the Controller and Auditor General has pointed out that very few companies that large cases division deal with pay penalties. So you never see a large company, an IDA client, in the Irish Times or whatever, the annual list of defaulters. They're just not in there because they never pay penalties, or very few of them pay penalties. They seem to be able to get out of this list. There are other issues involved with the tax collection. So maybe that's the issue, that these companies are very deeply rooted in the countries where they operate. They have tremendous political power and tremendous economic power. So maybe, and their tax advisors have also economic power. So maybe that's a reflection. But nevertheless, states are coming up against the problem that they need tax. In Germany especially, and in lots of other countries, they need tax. So I think there will be movement because of that.
Yes, fine. Here.
I think we're in agreement that there needs to be a bigger tax intake and corporate tax, and I think through as you say, for the UN level is probably the level that we need to be at. But I'm just wondering about the companies that, if the legislation is brought in and then they just can move, international companies can just move around and move their profits, from Ireland to other countries, that surely some participation from those companies in the legislation. They themselves have made huge profits. They run very successful companies. They keep their staff very happy. So, if they give them the job, say, you know, if you were head of these countries, how would you solve the issues of redistribution, of employment, of climate change? How would you go about doing that? And, you know, and what sort of resources need to be put on that? And if you were to contribute to those resources and have them participate and agree to the legislation, I think we'd be much more likely to actually follow through and with that.
Okay. I'll take that as a contribution rather than a question. And
I'm wondering what level of participation from the. I know they have policy. I know that they have people working in terms of trying to influence policy at government level and look at what policies coming down the line. But what sort of participation are you getting from, let's say, the CEOs from these companies?
Okay, we'll raise that when the politicians join us in part 2 of this seminar.